S&P 500 was at 3,800. It closed at 4,700 today. You know where the 10-year yield was? It was at 3.5%. You know where the 10-year yield closed today? At 4.01%. So there's something out of whack, okay? And Jeff Gundlach also said this, and I thought this was really interesting. Stocks need bonds, but bonds don't need stocks, and that's going to be a story of next year. And that's why I'm sticking to my guns here, Mel. Well, what he's saying is, okay, that bonds this year did a thing based on what the Fed had said they're going to do, right? And as soon as they went from 5% to 4%, it was liftoff for the stock market, right? The flip side might be true next year. Once the Fed has kind of given up on what they think they needed to do, that bonds might continue to do something. He also said that he thinks that when they start cutting, and this is something that Guy has said quite frequently, that they're going to actually have to get a lot more aggressive, and that won't be favorable to stocks because the reasons that they're going to need to cut will not be supportive of risk assets. Karen.
Well, a couple things. We talked about that, comparing that bond rate. That was, though, when they were just starting to begin a hike.
Not last year. No. Last year, I mean, think about it. The 2-year was higher. It was 4.5% or something like that. I mean, at some point, at the end of last year, rate cuts were...
But the 10-year was going into a hiking cycle. Now we are the hiking cycle is over. They've told us it's over. So I think that's different. But, I mean, what a crazy broad rally, which is good. I mean, we've been wanting a broad rally because as that Magnificent Seven just was higher and higher, there was more risk there. And so they had a very, not great day, certainly underperforming. So I like seeing it broaden out. I have been bearish bonds lately, so that didn't work today. But I don't know. It feels like this reaction was a little bit heavy because I think this expectation is what's been pulling the market up for the last two months or so.
Heavy in the sense it was overstated?
Yes.
Overstated
yes.
Reaction.
Right.
Guy?
Well, I mean, we've talked about for the last few weeks how there's seemingly 4, if not 5 rate cuts priced into the market for next year. So they basically came out and I think just sort of galvanized those thoughts, but the market, for whatever reason, sort of jumped on that and took it to the next level. So today was a remarkable day. When you see an 18 basis point move in 10-year yields on the back of what's been a 75 basis point move from 5% down to 4.25%, you have to take notice. I mean, stocks seemingly across the board love this, but I'll say this. Great stock market. Maybe the Fed is threading this needle, but right now there are, I think, 45 million people in this country. It's no longer called food stamps. It's called the Supplemental Nutrition Assistance Program. That doesn't speak of some great economy. And 62% of Americans live paycheck to paycheck. That's not me making numbers up. That's coming right from the government statistics. So stock market saying one thing, economy saying something entirely different. And, oh, by the way, I think the Fed even acknowledged this. The lag effects haven't kicked in terms of the rate hikes to this point. So we'll see how it plays itself out.
Yeah, well, we'll talk a little more about the economy with our next guest, Joe Livornia, in just a moment. But, Carter, let me let you button off this conversation in terms of maybe how should I interpret what the Fed has done and said and put it to work in my portfolio.
Right. Well, one thing, maybe an anecdote that's worthwhile. The consensus among my clients, right, which range from long short to long only, could be big pension plans or just small hedge funds, that it's all about rates, and we know this, so that's not elemental, that's not new, but it's all about 5 to 3.5. All good, Goldilocks. We go below 3.5, and then we have a problem, because it means that really something is wrong on Main Street. So maybe this is the Goldilocks, maybe we get a little higher, but ultimately, I think we're going down below 3.5%, and then the stock market will wake up.